Thank you very much. I'd like to call to order the regular investment committee meeting of the Kentucky Retirement System on February the 18th. Understand we have a quorum, and could we have the opening legal statement, please?
This is the regular meeting of the Investment Committee of the Kentucky Retirement Systems Board of Trustees. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statutes, Section 61.826, and may be viewed by the public at the Kentucky Public Pensions Authority offices at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. Please ensure that you are on camera when making or seconding a motion or casting a vote. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you very much, Nathan. Could we have the roll call, please, Sherry?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins, Miss Bova,
Here.
and Miss Thompson.
Here.
Thank you.
Thank you very much. And it does look like we have a quorum. A public comment. I understand we have one. Sherry, would you like to read that for us?
Yes, we did receive only one for this meeting, and it is as follows. This is submitted by Kenneth Shane Wall, and it just reads, House Bill 406 and the additional payment it provides for retirees is critical. Please approve this bill. Thank you.
We will note that we have received that from him, and this committee will pass that on to the full board. Now, the approval of minutes, everyone, I believe, has received those. Any comments or changes that need to be made? Hearing none, we will, by acclamation, assume that the minutes are approved. Thank you. And so the next item on the agenda is the investment review. Unfortunately, Stephen is not with us. He's had some family issues. His son's had some health issues, and hopefully our thoughts and prayers will go with him that his son quickly recovers, and they're having a tough time there. But Anthony is with us to lead the investment review, and all I'll say is editorially is it's pretty crazy times out there. I think we're well positioned to deal with these the issues and volatility that are taking place, but I've seen it in my career many times like this, but in the last several years, there's probably been a few times where there's been has divergent of opinions about what is going on in the public stock market. So, Anthony, you want to take it from there?
Sure, yeah, thanks, Priya. I think that's a pretty good lead in. Yeah, good morning, everybody. We don't have any managers to present today, so this is mainly going to be an update for how things went through end of calendar 2025. We're also 6+ weeks into the year, so we're going to go over the market economic section pretty quickly. And then Joe, Brian, and I will give some asset class detail, and then we're happy to take any questions from y'all. So if we go to page 8, please. Okay. Well, it's another strong year in the market. S&P 500 is up. It has been up at least 18% for 6 of the last 7 years. So obviously a lot of people, people have been long, been great. Credit spreads are also at all-time tights. We hear that from different managers as well. But at least there's some yield now that rates aren't zero. But if you look at this page, what this tells us is, basically a lot of things are pretty fully priced compared to history. We don't take these assumed rates of returns literally more directionally probably, but you can even see here core bonds, we'll sure expect them to return more than US stocks, right, over the long term here. So, the takeaway from that is there's not a lot of reason to stretch risk-wise, especially here on the case side for us where, we have a lower assumed rate of return. You get a lot of the way there with fixed income. So next we go to page 23, please. Okay, here you can see here every sector was up over here. Obviously, yes, sectors did great. Concentration is still very large. I think that's been happening for several years now with the Mag 7. I think NVIDIA and Google just by themselves were almost a third of the return last year for the S&P. Over half of that, 18%, was 7 stocks. So as Pruitt mentioned, and everyone's probably heard, AI has been dominating the narratives in our market. Not included in any of these numbers is what it's done to the software sector just year to date. First, you can look here. It seems like just more of the same as every year. Large beats small, growth beats value. Although if you go to page 28, please. You can see, finally our tilt towards non-US has paid off. Those markets internationally, things did very well last year. Equity, ex-US, and EM both almost doubled out the S&P's return. The next page is 29. Fixed income did its job, did well. And then if you go to page 32, please, you can see our long-term rates in 10-year treasuries at 3 to 4%. We're going a long way towards our senior rate with just those, with just fixed income there instead of 1 to 2% like it was the first 5 or 6 years that I joined here. We can turn to page 45, please. This is our performance for the first half of the fiscal year. Again, and so all the K plans are around up to around 6%. Has a benchmark maybe around 20 to 50 basis points depending on the plan. That's mostly real return, specialty credit, and some overweight to public equity that are the big contributors. Speaking of public equity, I can pass it on to Joe now to provide some detail on that area and also a little bit of info on one of his managers. So Joe, if you're ready.
Sure. I guess if you'll share, if you don't mind going over to page 48, and I'll try to give some detail on the asset class and try to keep it somewhat brief at the same time. As Anthony alluded, strong markets for 2025. Fourth quarter was no different. It was a risk-on environment that really accelerated back in April, but this has been going on for several years now. For the quarter, modestly higher. Higher beta and lower quality stocks really is what drove the market. As he stated, large caps outperform small caps. That's been an ongoing theme for some time. A little bit different this quarter. Value actually outperformed growth, which we hadn't seen for really probably 6 or 7 quarters. So that was a little bit of a reversal. He mentioned with Wilshire's assumptions, core fixed income being or fixed income in general providing a little bit better return going forward maybe than the public markets. We're still constructive on the public markets, though we are very cautious. From a fundamental perspective, things look fairly healthy, but volatility is higher. I think Pruitt had mentioned that. That's likely to remain. At the same time, we are starting at a very high valuation, so we are cautious with that. So we think any movement forward is really going to be earnings driven rather than multiple expansion. Anthony discussed the narrowness of the market. That's been an issue across the portfolio, not only in the U.S. Part of the portfolio, but also the non-U.S. A little bit different reasons, but the narrowness has caused some problems for our active mandates. We do think large caps are going to continue to do well, though their earnings look like they're contracting or a little bit from a growth perspective, the growth rates that is. Small cap growth rates look like they're actually going to be expanding. So we think that's some evidence that some broadening is likely to occur as capital kind of flows from some of the large caps into the smaller caps. We are positioned a little bit smaller. And while that was a bit of a headwind for us in 25, we're hoping that that's going to be a bit of a tailwind going forward. Sure, if you don't mind going to page 49. In the international markets, they performed really well in the fourth quarter. They actually doubled up the U.S. markets. So our tilt that direction was a benefit to the portfolio. We are tilted that way, largely in due part to valuation. While international markets from a historic standpoint are a little bit elevated versus their U.S. counterparts, they are at a steep discount. over there. Value has outperformed growth for several years pretty dramatically. The macro environment is okay. Inflation does remain relatively high, but the central banks seem pretty accommodative over there. We've mentioned the narrowness of the market. That's kind of a general theme for 2025. It's the international markets were driven by a handful of stocks. It's very narrative driven. The AI phenomenon is there, but also defense spending with Russia and Ukraine. Germany passed a pretty significant defense bill, so anything tied to defense did well. Let's see. Let's go on, if you would, Sherry, to page 50. This is kind of a little bit of a generic comment, but it across the entire portfolio, the risk on environment has really, while it's propelled the markets higher, it's one of those rising tide lifts all boats kind of things where some of the lower quality names have really responded to a little bit better economic news. And the idea of future rate cuts really drove the lower quality names, regardless of the style or the region. That's been an issue for our active managers. Typically, you don't want to, for the long term anyway, invest in lower quality stocks. That's a recipe to usually underperform, but there are short term periods where they can really drive the markets, and they've done so. And that shorter term has been a little longer than we would have expected. So that has been an issue for us. In addition, in our international basket, growth style mandates have had an issue in that value has significantly outperformed growth in the international markets by the tune of about 9% annualized for the last 5 years. So that's been a headwind for some of our active managers. And in general, the correlation between earnings and stock performance has been declining over the last couple of years. So fundamentals haven't meant as much as active managers attempt to pick what they think is going to be the winners. They haven't always been rewarded. And so that's kind of a backdrop across our entire portfolio, whether U.S. or non-U.S. But for the fourth quarter, we earned 2.6%, trailed the benchmark. Again, thanks basically to those style headwinds and factor headwinds that the active manager are facing for the most part. The U.S. portfolio performed relatively in line with its benchmark. Allocation decisions for the quarter didn't have much of an impact. Performance was relatively split amongst the active managers. I would say a little bit of weakness in our all cap growth mandate. That's really, frankly, due to diversification. And I'll just kind of jump ahead, but that's been an issue for both U.S. and non-U.S., where the narrowness of the market, we want to be diversified for the long term. However, I was reading somewhere and they put it in an interesting way that diversification was forcing underperformance in that it's such a narrow market. The only way to really compete and stay with it is to put essentially all your eggs in just a couple baskets. And that's just not what we do as a public pension plan. In our non-U.S. portfolio, we returned a little over 4%. Underperforming. That again, growth mandates we'll talk about that here in a minute. Though we did have some bright spots, and our deep value manager did really well. Our dedicated EM managers did well. And then, Sherry, if you'll go to page 51, this is the 12-month 2025 overall. The global equity portfolio had a great absolute return, 21.5%, underperformed by about 50 basis points. Individual manager performance was broadly weaker, again, to those style and factor biases that we had. The low quality and high volatility headwinds were felt throughout. Offsetting that was, Anthony kind of mentioned, the overweight or the tilt towards non-U.S. finally kind of worked out for us. That kind of saved the day and kept us in line with the benchmark. You'll see our U.S. portfolio earned 16.5, where the non-U.S. was over 30% there. And then we did talk. Anthony mentioned, if you'll go to page 52, we were going to mention a couple of the managers in particular. Steve and I were talking, and this is kind of one of those high nail comments where there's some that are kind of blinking lights at the moment from a relative performance perspective, and kind of what we think and what the manager has attempted to do to correct some of those issues. American Century is one of them. I will note when you look at the performance there on the right, they're being marked against the core index. All of our international mandates I mark against the core index because they were brought on as a basket of strategies to outperform the core. So they're a growth manager. So you heard me mention that values outperformed growth by 9% annualized for the last 5 years. So when you look at a 5-year number, them being down 6% versus the core, if real quick dummy math would say roughly 4.5% of that or 75% of that underweight is kind of related to that style headwind that they're facing. So it's not as ugly as it looks on this paper when you look at them and judging with the style that they're in. However, that doesn't mean they didn't have some missteps. They really struggled kind of coming out of 21. There was a violent rotation from growth to value, and they held on to some of their winners probably too long, allowed the PE multiples to get too high, and they've acknowledged that they need to be more tactical in their profit taking, recycling that capital into other ideas, being more mindful of valuations. Growth managers a lot of times are willing to pay up for growth. Sometimes the valuations get stretched and they're okay with that, but they basically have acknowledged that they let those get too far. Exogenous events seem to happen more and more frequently. They are going to have to start doing a better job with scenario analysis. They've acknowledged that as well, and so they know what went wrong. They've taken some corrective actions against that. I really like the team, the philosophy behind the strategy. I still have confidence in the manager, and so essentially we just need more agreeable markets for their type of investing to see a turnaround. Though it's disappointing, I still believe this strategy merits being in the portfolio. Sherry, if you'll go to the next page. Franklin Templeton is an aggressive growth manager. When growth does well, they do really well. When growth does poorly, they do really poorly. Looking back at the history of their performance, this is when a manager just a few short years ago was the best performing manager in our entire portfolio. They've really struggled the last few years. Again, that value headwind has been significant for them. The narrowness of the market has really hurt them. And in addition to that, they are a little smaller, so they're more mid-cappy, and mid-caps in the international space have really trailed large caps. So they kind of had the perfect storm hit them the last couple of years. In addition, they have had missteps that's manager related. So they had an analyst in the healthcare sector. 2024, those investments lost 9% relative to the healthcare sector. That analyst is no longer with Franklin Templeton. The new analyst came on in early 25. I met with them several times. They turned over that part of the portfolio pretty much wholesale. And in 2025, it was actually accretive to the portfolio. So that change looks to have been good. They're also getting more aggressive in their what I'll call a stop loss. Basically, if a security is underperforming relative to its peers by 20%, it's an immediate a re-underwriting, we'll call it, with a strong bias towards kicking it out of the portfolio. It has to make a strong case to stay in the portfolio. In addition, some additional risk metrics have been put around the portfolio, tracking errors being limited to roughly 6% of a position. It's a very concentrated portfolio. Tracking error in the past has been allowed to run anywhere from 8 to 10% potentially, which unfortunately is the tail wag the dog kind of event. If you have one or two blowups, that can really derail the entire portfolio's performance. This 6% limit allows the positions to be meaningful from a potential accretive standpoint. However, it hopefully will limit the downside of that. This has been an issue. Again, they built up some really goodwill with us from an inception performance. Up until recently, it turned negative. We've also had a manager in the past who followed a similar path that they did essentially an autopsy, figured out what changes needed to be made. They made it. We stuck with them, and it turned out to do very well for us in our portfolio. So, there was probably some comfort from me that I thought this could turn around. I still believe that it can. It is going to require a different market environment to do so. So we are really there's some decisions that have to be made with this one. In the meantime, we have renegotiated fees retroactively back to the fiscal year beginning. I didn't put the fees on this page, but if it gets any cheaper, they'll start cutting checks to us. So you can read between the lines of what that means. But that will be the case for some time. And again, it's one that's some hard decisions are going to have to be made. Maybe speaking of fees, I'll try to end on a positive note. Over kind of the December month, I renegotiated fees with 7 of our active managers, trying to get everybody in the cheapest quartile for active managing. And so what we did, we renegotiated with 7 of those managers. Annual savings across the board is expected to be over $4 million a year. That includes a significant chunk from Franklin Templeton here. If we were to take that out, annual savings is still projected to be over $2.5 million a year going forward, which equates to about a 12.5% discount on those active managers that we renegotiated with. So that's a little bit of a positive to follow up on a not so great report on a couple of our managers. So I'm happy to take questions or pass it off to Brian for fixed income commentary. So.
Joe, I was looking over a few of the numbers, and it looks like you've got a couple of home runs that you should have kudos for. Pazina and the MSCI X portfolios have been home runs, and Pazina was somebody that wasn't, I don't think, terribly well known.
They weren't.
And you guys did a great job.
They've done well for us. Next Century on the microcaps done really well for us. So we have had some good ones though. We want to acknowledge when there's some that aren't going well and let you all try to give you some comfort, and we're aware of it. We're having conversations. We're trying to come up with solutions for those issues. So we didn't want you to feel like we weren't minding the house. So
yeah, well, we like the good ones too. But that was great. I think
I'll
that was a
highlight
great
a
job.
good one next time. So.
Yeah.
I mean,
Thank you.
personally, I'm a believer that if a manager is underperforming because they are sticking to their style and what we would basically expect from them, then I'm comfortable with that. I think it's dangerous to try to just chase the best performance and expect every manager to always outperform.
Right. No, I appreciate that. We don't want to chase performance. We don't want to see the level of underperformance we've seen. Unfortunately, again, with Franklin Templeton, it really is kind of a perfect storm where you see that chart to the right that shows the cumulative underperformance of the last year due to those different factors they're facing. And that does not include the market cap, which was also significant. So it was, that's not to say, again, that they haven't misstepped. They've acknowledged it. They've taken corrective actions to the extent that they're capable of doing. Now it's really a market thing. And that's beyond their control. And so we just have to decide if we're comfortable or not.
Right.
So. Okay. Well, if there's no other questions, Brian, I guess you're up.
Thanks, Joe. Sherry, I'll start on page 54, please. Thank you. Core fixed income. The yield curve steepened over the final 2 months of the year as the Federal Reserve announced 2 more rate cuts. Yields seesawed over the quarter, with the 2-year falling at roughly the same rate as the 30-year rose, with the belly of the curve effectively unchanged. The 2-10 Treasury spread widened into year-end and finished the quarter at 69 basis points, up from roughly 54 basis points at the end of last quarter. Next page, please. Thank you. The core fixed income portfolio generated just over 1% for the quarter and 3.24% fiscal year to date. The top 3 performing sectors for the quarter were MBS, CMBS, and ABS, generating 69, 17, and 16 basis points of excess returns, respectively. Investment grade credit spreads widened 4 basis points for the quarter, finishing 2025 with an option adjusted spread of 78. Next page, please. Thank you. Specialty credit, the specialty credit portfolio earned just over 2% for the quarter and 4.64% fiscal year to date, outperforming the custom benchmark for both time periods. Returns by quality were mixed over the quarter, with lower quality issuers underperforming, with BB, single B, and triple C rated issues returning 152, 157, and 14 basis points respectively. There were 10 rising stars for the quarter against 1 fallen angel. Despite the imbalance, 2025 fallen angels outpaced rising stars by $11 billion. Next page, please. Thank you. High yield spreads only tightened 1 basis point during the quarter to an option adjusted spread of 266. However, for the calendar year 2025, spreads tightened 21 basis points, ending the year at the tightest level ever. The high yield market delivered its third consecutive year of over 8% total returns in 2025. While the quarter's return was more muted and spread volatility increased, overall spreads continued the trend lower as the view on the macro and fundamental backdrop remained positive for corporate credit. Next page, please. Thank you. The Federal Reserve delivered a third consecutive rate cut for 2025 at their December meeting, though it may have been the last for this round of cuts. The FOMC statement said the committee would consider the extent and timing of future rate cuts, language they have previously used to signal a pause. Chair Powell reiterated that policymakers felt well positioned to wait and see how the economy evolves. Despite signaling a pause at the next meeting, the Fed clearly maintained an easing bias as Chair Powell sounded very dovish on the labor market. The Fed dot plot has current expectations of only 1 25 basis point cut in 2026. However, short rate markets are pricing in 2 cuts for 2026, with the first one in June. For the quarter, performance matched the benchmark, returning just over 1%, and the fiscal year-to-date return was a little over 2%. I'll turn it back to Anthony to talk about real estate, real return, and private equity.
Yeah, thanks. I just want to highlight a couple of things also. As you can tell, Brian and Joe are really on top of their areas, even as there's some different risks going on in all these markets. And obviously very focused on fees and utilizing our leverage there, because I think especially in Brian and Joe's area, we can get risk very cheaply. So if we're going to pay our active dollars for alpha, these things have to be better or different or both, especially with spreads at all-time tight that you saw on Brian's chart there. We have several managers who are obviously highlight those concerns and hopefully underwriting very carefully in that kind of environment where people are willing to bid things at that level. Now we can go to the next page, please. Overall private markets here, you can see they've done fine. Nothing spectacular, all positive also, but they did not keep up with public equity benchmarks. They did not annualize at 20% over the last 3 years. So what I'm saying here is you can see how credit and real assets have outperformed regular private equity and venture, given how difficult it has been for those markets to have activity. Basically, assets that were bought in the 21 timeframe have not grown enough to meet those valuations for exit. So you have a lot of just standstill in those markets. Although we've seen a little bit more activity start to happen in the second half of 2025. We had several exits in our portfolio. So there's some activity, but it's still pretty slow, and there's quite a lot of dry powder out there too. So it's something else that we're watching for, but as you can tell from our activity, we've not been wildly active there yet, since there's still a lot of constrained activity at this point. So, but back to what Joe was saying in terms of reducing fees, there's been the leverage has swung a little bit more towards us in terms of fundraising's been a little slower, and so there's a little more, our dollars are a little more precious rather than when everybody's willing to write checks for these things. So, all right, we can go to the next page, please. Speaking of things I've done, awesome real estate. Basically, what this says here, you can see on the right, the orange bars with the red circle. That's the markdowns that's been happening in real estate. So slowly but surely, funds have been marking down the values of the properties. because they just aren't meeting the projections people thought they would. Most of our real estate exposure is 3 open-end core funds in the United States. One that's fully industrial, one that is they call them more alternative. They aren't the traditional office, retail, and multifamily. They have more student housing, storage, medical office. So that's another area of exposure. And then another one is more traditional. So those have all done well, but most of the returns there have just been the income because the appreciation has been flat to down. We do see that starting to turn a little bit, and there are gated until the funds are able to sell properties and give them